green. So let's go across to someone who tracks the mid-cap as well as small-cap space very, very closely. We have Anand Shirgaonkar, Head of India Equities at UBS Securities, who joins us from the sidelines of UBS's India's 5th annual small-cap and mid-cap conference. Hi Anand, thanks so much for joining in this afternoon. Anand, what's the mood at the conference? We have seen that the headline index has corrected a good 12-13% from the top. So what's the mood like in terms of mid-cap as well as small-cap space? Are investors quite fearful now to get into any of them? How are you reading it?
No, so I mean, a lot of the institutional investors who we deal with are actually pretty happy about the corrections that we saw, because as compared to say 2 months ago, we're getting some of the mid caps and quality mid caps at lower levels, and most of the investors are looking forward to spot some ideas in the conference, and they're trying to figure out from the managements of the companies, one, whether things on the ground, as far as what the management are seeing some traction in terms of improvement, and whether the business prospects currently are showing some signs of revival, and secondly, their outlook over the next 2 to 3 years. And coupled with the management quality, a lot of the foreign investors and domestic investors on the institutional side are very busy spending time to spot some value and spot some bright ideas which they could hold and buy with the next 2 to 3 year view. So actually, contrary to what most would expect in terms of sentiment, the sentiment is actually very upbeat in terms of trying to find and gauge new ideas which could help and generate returns over the next 2 to 3 years.
Okay, that's good to hear. Anand, hi, afternoon. Because, generally when the market is in a bear grip, mid-caps are a scary place to be because of the fear of capitulation. So from the managements that you interacted with at the conference, what was the key takeaway? Is there any pickup in demand at all across sectors? Because we've been speaking to a lot of companies and we get a sense, especially from companies in the cement sector, etc., that things are just going from bad to worse. What's the sense that you've got from a lot of the corporates that you speak to?
No, it depends on the sectors that you talk about, but we have quite a few managements across various sectors, but most of them are talking about improvement at the margin, although it is very small. So say some of the consumer names are talking about how there was a much bigger lack of demand over the last year, and now they are seeing some signs of improvement in the first 2-3 months of this fiscal year which have gone by. Similar, we're seeing some situations in banking, smaller banks as well as smaller NBFCs, when they're seeing some small signs of revival. And most importantly, most of the managements believe that the government is doing a lot of steps which would result in improvement over the next 12 to 18 months. So I think the prospects for improvement is what is more exciting as a story from the managements, mostly from quality managements in some of the sectors. Although I agree with you, I think some of the cyclicals and cap goods sectors, I think those managements seem to be less upbeat about about the recovery and signs of recovery that they're seeing currently. But that again, we need to keep in mind that on the cyclical side, the cyclicality is much longer, and therefore it takes longer for the government to make changes, and therefore for those changes to start showing into numbers for these companies. But other than cap goods and industrials and infrastructure, I think most of the other sector management seem to be seeing some signs of improvement.
All right, Anand, that point's well taken then. In fact, maybe we are on the right path and maybe recovery is going to come about. But I was just looking at a note, and you've revised your Nifty targets a couple of times downwards. That's because you have altered your earnings as well. But at 17 times is a split verdict. Are we at the upper end of the range, or do you think that around 15-16 times investors will be more comfortable? What's your take on that? Do you believe at 17 times, and do you think the earnings growth of around 10%, that's going to play out, or do you think that there is some kind of downward risk even to that at current levels?
No, so we expect about 10% earnings growth on a top-down level for F16.
Right.
But if you look at what the street is expecting, there's a big divergence over there. Now, after the March 15 results, we saw that the street downgraded March 15 actuals, as well as they reduced March 16 forecast. But the March 16 wasn't reduced as much, and therefore the growth estimates for March 16 on a consensus basis now stands at 20%, which used to be 18% earlier.
Correct.
So what we are expecting is over the next 2 quarters, the street expectations would actually be lowered from this 20% lower expectations for F16 closer to the 10% level that we are expecting on a top-down level. Now, when that happens, typically the market would take that as a subdued indicator, and therefore we would expect prices for select companies or sectors to actually react to that and therefore soften. So what we are saying is we would have to endure 2 quarters or maybe 3 quarters of earnings downgrade, and the market's sort of taking some time to digest that. But once that is done, we actually start looking forward to the next 2 to 3 years, wherein the growth would expectedly come back to about 18% for F17. And keeping that in mind, we expect the revival to play out towards the second half of the year, which effectively puts our target to 8600 for the Nifty.
Okay. Just coming back to individual stocks, you mentioned that you're seeing a demand recovery, or at least the managements of these smaller banks and NBFCs are indicating demand recovery. You like 2 of these companies, SKS Microfinance and Cholamandalam. SKS was the big story of the last year. I mean, it had a huge upside, but this year it hasn't performed yet. What kind of an upside trigger do you see there, and what is the incremental story there?
No, so I think on individual stocks we are sort of prohibited to talk about, but generally on financials, if you look at quality managements and quality promoters, they've done 2 things. One is that they have kept their book cleaner and they've acted proactively in terms of reducing the asset quality risk, and therefore in some of the better managed banks or NBFCs, the asset quality risk is extremely low. And at the same time, because they've been sort of more defensive in terms of lending in the earlier years, they've got sort of a war chest which they can use to sort of lend more aggressively when the economy starts coming back. So I think that's what would differentiate financials which would do well over the next 2 to 3 years versus financials which would actually be grappling with the asset quality issue in the same period. So that's where we are differentiating. And the second point is, as a firm, we are of the view that the wholesale rates would actually keep coming off over the next 12 to 18 months because the inflation would surprise on the downside. So our view on the 10-year yields is that it comes back to about 6.5% by F16. Which means that the borrowing cost for some of these wholesale funded institutions would keep coming lower, and therefore the best sweet spot in financials would be buying into wholesale financials or wholesale funded financials, which would be the biggest beneficiaries of lower interest rates over the next 12 to 18 months.
All right, so you see the bond yield come down all the way to around 6.5%?
That is our call, yes.
All right, Anand, then let's talk about some more about some sector-specific, at least mid-cap picks. You seem to be liking the online penetration space. Take us through that particular reading.
No, so I think that is going to be a secular growth story over the next few years. We've come out with a very detailed piece on the internet space, and we believe that this could be a game changer, not only for the newer companies which are in that internet space, but also in some of the existing companies in consumers or financials or banks, which would also be aggressively deploying their digital strategy and benefiting out of this trend. So we met quite a few banks last week as part of our financials trip, and each of these large private banks had a digital strategy, and they are working very aggressively to implement the digital strategy. So you would see massive changes in terms of how the products get delivered and the time and efficiency in terms of delivering these products. So you should expect the digital strategy for banks rolling out, digital strategy for consumers rolling out, and probably efficiencies helping these banks in terms of reaching the consumers faster as well as at a lower cost. So there's a margin benefit angle involved in this as well. So quite a few companies, both on the internet space, consumer space, financial space, would end up being big beneficiaries out of this trend.
Okay, just one final question. Since we've been trying to gauge the mood across a lot of these conferences, wanted to get your take on how optimistic the corporate world is with regards to the government. I mean, same time last year, everyone was extremely hopeful and gung-ho, but now do you think there's some amount of disappointment that has crept into India Inc. With respect to the government's actions?
I would say that is more of realistic expectations now creeping in rather than disappointment. So I guess now more or less there is a realization that what we were expecting, or what most people were expecting at the time of the elections in terms of major changes or major results being delivered in 1 year's time was unrealistic, especially for cyclical sectors or infrastructure or cap goods or power sectors, which are, essentially have got much deeper problems which would take longer to resolve. So I think that realization is now creeping into corporates as well as the fund managers and the sell side. So to that extent, I think now onwards we would expect all these participants in the market to be more realistic in terms of what we should expect over the next 2 to 3 years. And that is where I guess sectors are being differentiated in terms of what is doable in the next 12 months and what is going to take 2 to 3 years. So depending on each fund's time frame and their style of investing, funds are positioning themselves differently in terms of what sectors, what stocks they would like to play for. And I think that is how now the funds as well as corporates seem to be reacting to the progress from the government.
All right, Anand, one final question before we let you go. Give us a realistic real GDP growth number for the coming fiscal.
No, so we are at about 6.5%, and 7.5%. Then we're expecting that to go to 7.7%.
All right, Anand, thanks so much. A pleasure talking to you this afternoon. Thanks for giving us all your views.